Hello everyone. Now we'll take the quick revision of mergers and acquisition chapter. So we will discuss the formulae that are used in this chapter. So these formulae are printed in your book. You have got one formula book. Keep that formula book open, mergers and acquisition chapter, and all the formulae that I am going to discuss now will also appear in your book. In case if you want to write down anything extra, you are most welcome. First basic formula of this chapter is EPS. What is EPS? EPS means total earning divided by number of equity share. Total earning divided by number of equity shares. And how do you get total earning? It is earning after tax minus preference dividend. Next basic formula is in this chapter P ratio, which is market price upon EPS, or you can also say it is total market capitalization divided by total earning. So I will write one more formula here, or total market capitalization, keep writing whatever you want, divide by total earnings. If this information is given, then you can find out P ratio in this manner. And then the third formula is market price. Market price per share is equal to P ratio into EPS. So we are just playing with the same formula depending upon how the question is asked. Now fourth very important, tick mark, very important formula, calculation of EPS of the combined entity, which we will call post merger EPS. Post merger EPS formula will be EPS of combined company A and B equal to PAT of A plus PAT of B plus synergy value if any, plus synergy value if any. So numerator will be every time PAT of A plus PAT of B plus synergy value if any, divided by total number of shares after merger. Divided by total number of shares after merger. In case of stock deal, stock deal means shares are issued to target company. It will be number of shares of A plus share exchange ratio multiplied by number of shares of B. So that will give me total number of shares after merger. But in case of cash deal, the number of share after merger will be only the number of shares of A. So that much care we should take. Next is, in some exam question they have asked you to find out the net cost of acquisition. Net cost of acquisition would be the consideration paid minus net asset realized immediately on disposal of asset and liabilities. Consideration paid minus net asset realized on disposal of assets and liabilities. So what are the things you will add according to question? First we will add market value of equity share issued, market value of debenture issued, plus market value of preference share issued, plus payment of current liability, plus payment of unrecorded or contingent liability, and plus any other expenses paid. So these first 6 items you will add, minus sale proceed from sale of asset not required, minus cash in hand and cash at bank received. This may not be mentioned in the adjustment, but if cash and bank is appearing in the balance sheet of the target company, you will deduct it, and the net amount is called net cost of acquisition. There are 3 notes relating to this. Note 1 is current liability must be paid even if the question is silent. Second, sale of asset is to be taken only if the question requires and the asset is not required in the business. Third is cash will be deducted. This is important because all the questions in the exam are silent about cash and bank in the balance sheet. But cash and bank will be deducted even if the question is silent. First, now come to sixth number formula. EPS of A and B when synergy is expressed in percentage. So they may just say synergy will be 5% after merger. So then the post merger EPS will be earnings after tax of A plus earning after tax of B into bracket 1 plus synergy gain divided by number of shares of A plus number of shares of B multiplied by exchange ratio in case of cash deal. Sorry, share deal. In case of share deal, if it is a cash deal, then you just have to write in the denominator number of shares of A. Next is when the synergy value is expressed in amount. So here the formula will be earnings of A plus earning of B plus synergy gain. Plus synergy gain. So they may say 250 lakh is the earning of A, 50 lakh is the earning of B, synergy gain is 20. So then in that case my total earnings will be 250 plus 50 plus 20 divided by number of shares of A plus number of shares of B into exchange ratio. This formula to be used in case of stock deal, the denominator. In case of cash deal, only write number of shares of A. Next paragraph, formula number 8. Post merger EPS when cash is paid out of borrowed money. This is called leveraged buyout. And in some recent exam, there was question on this leveraged buyout. So what I'll do, I will take earning of A plus earning of B and plus you also mention synergy. These three things will be there minus. Now you see what we will do when we borrow money and acquire other company, we have to pay interest on that borrowed amount into interest rate, and on that interest amount you get tax shield. So into 1 minus tax rate, borrowed amount into interest rate into 1 minus tax rate. This whole thing we can just call it as interest net of tax, interest net of tax, because after acquiring the target company we'll have to pay the interest. On interest we'll get tax shield, and more importantly in the denominator just write number of shares of A. Formula number 9 now, EPS of A and B when cash is paid out of business money. When cash is paid out of business money, then in that case there is an opportunity cost involved. So the formula for post merger earning will be EPS of A and B equal to earning of A plus earning of B and plus synergy gain if any, and then minus, you put in bracket cash paid into opportunity cost, because if you pay 100 crore rupees out of your business cash, you have lost the opportunity to earn interest on that into opportunity cost of interest into 1 minus tax rate, net of tax. This 1 minus tax rate is for net of tax. Again important thing, only write number of shares of acquiring. Do not add number of share issued to B, because there is no cash, there is no share issued. Cash is paid. When cash is paid, number of shares will not change. 10th formula, EPS of A and B after 1 year when growth rate is used. So after 1 year, the EPS of A and B will be earning of A plus earning of B into 1 plus growth rate of combined company, and that divided by number of shares of A plus number of shares of B into exchange ratio. So this formula will be used for stock deal. In case of cash deal, do not write this part. And how do you compute the growth rate after merger? If nothing is given in the problem, then post merger growth rate will be weighted average growth rate. That is growth rate of A into earning of A plus earning of A plus earning of B plus growth rate of B into earning of B upon earning of A plus earning of B. This formula is very rarely used in this chapter. Paragraph 11. MPS of A and B in the case of cash takeover. Suppose A acquires B by paying cash. So to the extent you are using business cash, your valuation will fall. So MPS after merger when cash is paid is equal to market value of A plus market value of B plus synergy gain minus cash paid and divide by number of shares of A. Now we'll come to some important formula. Merger value. Standalone value of acquirer plus standalone value of target company and plus synergy value. So post merger value of combined company, post merger value of combined entity will be the standalone value of acquirer plus standalone value of target plus synergy value. Then nowadays they are asking this question, what is the cost in a merger or true cost in a merger? Suppose firm A acquires firm B. The cost in a merger of company A and B, if settled through cash, if it is cash deal, then just check how much cash is paid. Cost to acquiring company, or I can add the word true cost. True cost to acquiring company is value of consideration paid. That is cash paid. How much did you pay? Minus what is the value of the target company, PVB. The difference is called true cost of acquisition to acquiring company. If the merger is financed by the stock, if the merger is financed by shares, that is stock deal. Same logic, but here what we have paid to the target company is alpha multiplied by PV of A, AB. So that is the total value of the firm, total value of combined entity. And when I multiplied by the share exchange ratio, what we get is the value of target company in the merged entity. So this is what we can say value of consideration paid. This is what is paid against this value of target company PVB. The value the target company gets in the merged entity minus their standalone value is the true cost of acquisition to the acquirer. So what is alpha? Alpha represents the fraction of combined entity received by the holders of B. So that is their proportionate stake, ownership position. The word we have used in this chapter, ownership position or percentage holding of the target company, and alpha multiplied by post merger market value of A and B is the value of what firms B shareholders get in firm A. That means the value of target company in the merged entity. Value of target company in the merged entity is called alpha into PVAB. Value of the firm AB will be equal to PV of A plus PV of B plus synergy value. So what you have to do, See, you have to understand the process. First find synergy value, then find value of the combined entity, then calculate this alpha. This alpha will be the number of shares received by shareholders of B upon total number of shares. When you multiply by total value of the firm, total stake in the merged entity minus their standalone value, and the difference is the true cost of acquisition to A. PV of B means the value of what firm B gives up. NPV of firm A is equal to synergy benefit minus true cost of acquisition. NPV or net gain, you also add this word net gain to the target, to the acquiring company, is the total synergy benefit minus true cost of acquisition. And what is the NPV of firm B? NPV of the firm B is the true cost to firm A. NPV of the target company is the true cost of acquisition to acquiring company. Next point, market value after merger if there is no synergy gain. So if there is no synergy gain, the post merger market capitalization is market capitalization of A and plus market capitalization of B. 15 number of shares after merger. Now sometimes they can give you a reverse question. Earning after tax of A is given plus earning after tax of B is given, and possibly synergy gain is also given. Post merger EPS is given. So can I not do the reverse working and find out the number of shares? Yes. Market value after merger. Post merger market price. Very easy. Total market capitalization after merger divided by total number of shares after merger. Next paragraph. Share exchange ratio based on EPS. EPS of target company upon EPS of acquiring company. Next, share exchange ratio based on P ratio. P ratio of target company upon P ratio of acquiring company. Share exchange ratio based on market price. Market price of target company upon market price of acquiring company. Share exchange ratio based on book value is book value per share of target firm upon book value per share of acquiring firm. And you add one more thing here. Share exchange ratio based on gross NPA. Suppose in some banking problem this was asked. So now my formula will become gross NPA, GNPA of acquiring company upon gross NPA of, in case of those parameters where lower figure is better, the formula will reverse. So share exchange ratio based on gross NPA is this, or if they say share exchange ratio based on operating cost per share, then I will take the operating cost of acquiring company divided by operating cost of target company. So for those parameters where the minimum value is better, then in that case acquiring company upon target company. 20th number formula, post merger P ratio. So if the question is silent, there are two assumptions possible. One is post merger P ratio will be weighted average P ratio. that is P ratio of A into PAT of A upon PAT of A plus PAT of B. This you put in a bracket to avoid confusion, plus PAT of B into PAT of B upon PAT of A plus PAT of B. So profit after tax is being used as weights. Next is post merger MPS is post merger EPS into post merger P ratio. EPS can be found out as MPS upon P ratio. Post merger equity ownership, this you tick important. Equity ownership of target company will be number of shares received, new shares, upon total number of shares after merger. Number of shares received upon total number of shares after merger. An acquiring company's share would be 100% minus the target company's percentage. Either you first compute target company and take acquiring company as a balancing figure, or if you want to compute separately, acquiring company will be number of shares before merger, number of shares of acquiring company before merger divided by number of shares of acquiring company plus share exchange ratio into number of shares of target company. So this denominator will be same in both the formula. Total market capitalization after merger, total number of shares after merger into MPS after merger, into MPS after merger, or depending upon the question, it can be total earnings after merger into post merger P ratio, into post merger P ratio. If this information is given, this is how you can get the total market capitalization. 25 number, free float market capitalization. Free float market capitalization means market capitalization of the company excluding the market capitalization of the promoters' shares. So we will not include promoter share here. We will only include non-promoter share percentage. So the formula is free float market capitalization is equal to total market capitalization into non-promoter holding percentage. One example I'll discuss here. Free float market capitalization is 40%. Total shares 28,75,000. Market price per share is 69.60. So free float market capitalization will be 40% of total market capitalization. 40% of total share into market price. This gives you total market capitalization into 40% will give you free float market capitalization. How to compute swap ratio involving multiple parameters? This you have seen in many problems that swap ratio is based on EPS, book value, MPS, etc. So in that case, first you calculate the swap ratio on the basis of each agreed parameter. So calculate swap ratio on the basis of EPS, MPS, book value or whatever is given. Then they will definitely give you the weights. Multiply by the weights and you will get the weighted average swap ratio. Number of shares to be issued will be the number of shares of target company multiplied by weighted average swap ratio. Two more formulae. Sometime they will ask you a question, what should be share exchange ratio if the EPS of the acquiring company is to be maintained? So in that case, if the question does not have synergy value, then the formula will be EPS of target company upon EPS of acquiring company. So write down the formula, but that is subject to no additional profit. So to save time, you can just take EPS of target company upon EPS of acquirer. If you want that post merger EPS of the acquirer company should be maintained, and if the question says post merger MPS of the acquiring company is to be maintained and assuming no synergy benefit, then the share exchange ratio would be MPS of target company upon MPS of acquiring company. Use this two shortcut formula only when there is no synergy gain, right? So this was a very quick revision of mergers and acquisition. Thank you. If you have not yet subscribed to our YouTube channel, then subscribe. Our YouTube channel is AS Foundation. If you have any query, please send your query on WhatsApp number 9766921860, or you can send email also. For any product you want to purchase, you can log into our website www.asfoundation.co.in or our another website www.vino.in. Thank you very much. All the best.